Have you ever looked at the stock market and thought investing is only for wealthy people? Maybe you've seen headlines about millionaires, Wall Street traders, or people making huge gains from stocks and wondered if it's already too late for you. The truth might surprise you. In 2026, more ordinary Americans are investing than ever before, and many are starting with less than $100. You don't need thousands of dollars. You don't need a finance degree. And you definitely don't need to spend all day watching stock charts. In this video, I'll show you how beginners are building wealth with as little as $100 per month, the biggest mistakes new investors make, and a simple investing roadmap that almost anyone can follow. Let's get started. First, understand one important fact. Investing is not about getting rich quickly. It's about letting time do the heavy lifting. Many people think investing requires finding the next hot stock. In reality, most wealthy investors became wealthy through consistency. Imagine investing $100 every month. That may not sound impressive today. But over 10, 20, or 30 years, compound growth can transform small contributions into substantial wealth. That's why starting early matters more than starting with a large amount. The biggest mistake beginners make is waiting. They wait until they have more money. They wait until the market crashes. They wait until the economy improves. They wait until they understand everything. And years pass by. The reality is that time in the market is often more important than timing the market. Now let's discuss where beginners should start. Step 1 is creating an emergency fund. Before investing heavily, make sure you have some cash available for unexpected expenses. Many financial experts recommend saving 3 to 6 months of essential expenses. This prevents you from selling investments during emergencies. Once you have a basic safety cushion, you can begin investing consistently. Step 2 is choosing the right account. For many Americans, retirement accounts such as a Roth IRA or employer-sponsored retirement plan can offer significant tax advantages. Tax-efficient investing allows more of your money to stay invested and grow over time. If retirement accounts aren't available, a standard brokerage account can still provide access to stocks, ETFs, and other investments. Step 3 is understanding diversification. One of the biggest beginner mistakes is putting all their money into one company. Many new investors see a popular stock on social media and invest everything. That's extremely risky. Instead, diversification spreads risk across many companies and industries. This is why many beginner investors choose broad market index funds or ETFs. These investments can provide exposure to hundreds or even thousands of companies in a single purchase. If one company struggles, your entire portfolio isn't destroyed. Step 4 is understanding the power of ETFs. ETF stands for Exchange Traded Fund. Think of an ETF as a basket containing many different investments. Instead of trying to pick individual winners, investors can buy a diversified ETF and participate in the growth of a large portion of the market. This approach has become extremely popular because it's simple, low-cost, and beginner-friendly. Step 5 is automating investments. One reason many people fail financially is inconsistency. They invest when they feel motivated and stop when life gets busy. Successful investors often automate their investing. For example, setting up an automatic monthly investment of $100 removes emotions from the process. The money gets invested whether the market is up or down. This strategy is known as dollar cost averaging. When prices fall, your money buys more shares. When prices rise, your existing investments become more valuable. Over time, this can reduce the stress of trying to predict market movements. Now let's talk about common beginner mistakes. Mistake number 1 is chasing hype. Every year there is a new investment trend. AI stocks, crypto projects, meme stocks, hot startup companies. Some succeed, many fail. Beginners often hear success stories but ignore the countless failures. Instead of chasing hype, focus on building a diversified long-term portfolio. Mistake number 2 is checking investments every day. Markets naturally move up and down. Daily fluctuations can cause emotional reactions. Long-term investors understand that short-term volatility is normal. Mistake number 3 is trying to get rich quickly. If someone promises guaranteed returns, extreme profits, or risk-free investing, be careful. Real wealth building takes patience. Mistake number 4 is investing money you may need soon. Money needed for rent, bills, or emergencies should generally not be exposed to significant market risk. Now, let's discuss what successful beginner investors are doing in 2026. They're investing consistently. They're avoiding emotional decisions. They're focusing on long-term goals. They're learning basic financial literacy. And they're allowing compound growth to work over time. The greatest advantage beginner investors have isn't money. It's time. Even small monthly investments can become meaningful over decades. The key is getting started. Not next year. Not after the next market crash. Not after the next paycheck. Today. Remember, investing is a marathon, not a sprint. You don't need perfect timing. You don't need expert knowledge. You simply need a plan, discipline, and consistency. If you can invest $100 per month and continue doing it year after year, you may be surprised at what your future self thanks you for. If you found this video helpful, subscribe to Smart Money USA for more investing, wealth building, credit, and financial education content designed to help you make smarter money decisions. Thanks for watching, and I'll see you in the next video.